Good afternoon, everyone. It's my great pleasure to open this webinar on building wealth in the UK, which was especially conceived for Brazilians working over here. Considering the large number of Brazilian nationals living in this country, many of whom are working in high-profile jobs, understanding British specificities on investments, property, and tax is obviously crucial. This is why this webinar is so timely and important, and indeed today we will hear from our speakers on themes such as pensions, property, investment structuring, and crucially, tax. And for that, we at the Brazilian Chamber are truly grateful to our members, Fernanda Rossato of Mosaico Tax, Taihnee Bernardes of Dream Casa Mortgage Consultancy, and Tom Eason of Riverstone Financial Planning, who will be presenting and sharing with us their insight on the key differences between the Brazilian and UK financial systems, common pitfalls in property purchase and borrowing, the importance of integrated planning across property, pensions, and investments, and tax considerations when holding income and assets in both jurisdictions, Brazil and the United Kingdom. So a big thank you to you all, and I really look forward to hearing what you have to tell us. So having said that, and just before I ask Taihnee to please open our webinar, I would like to note that we will have a Q&A session today, and questions can be asked via the Teams chat box. So please feel free to send them to our speakers during the whole webinar. And now, without further ado, I would like to invite Taihnee to please start today's work.
Thank you, Vera. Thank you for the lovely introduction. So let me just start presenting There we go. So good afternoon. For those who don't know me yet, my name is Taihnee. I'm the founder at Dream Casa Mortgage Consultancy and a mortgage advisor. So I've spent the last decade helping Brazilians navigate the UK property market. So I've moved here 20 years ago, and I know that what it feels like to arrive in a country that in how to make sense of a financial system that works completely different to everything that we grew up with. So that's exactly what today is about. So not just the rules, but the thinking behind them. Because once you understand how the system works, a lot of the decisions become much easier. So let's get into it. So what we'll be covering here, I will try to keep us moving with pace because there's a lot to cover. So we're going to start by comparing the two systems, so the UK and Brazil. You can see exactly where the main differences are. And I'll talk a little bit about the mindset, which I think is one of the most important conversations that we can have. And after that, I'll go into the pitfalls, the common pitfalls that us Brazilians might be caught off guard whilst you are buying a property. So even the really well-prepared ones. So we do a bit of a deep dive into the stamp duty because it is the number one cost that can surprise a lot of people. And then I'll finish with a bit of a practical action plan that we can take away today. So once I'm done, Fernanda and Tom will build on everything that I've covered, so including taxes, pensions, investments. So let's get into it. So first, talking about numbers. So I believe, and I put them side by side because they are genuinely shocking. When we look at interest rates, Brazil mortgage rates have historically set around 10 to 15%, and sometimes even higher. In the UK right now, we are looking around 4 to 5%. Things might be changing a bit, but we don't know yet. And when we're looking at a standard fixed rate mortgage. So this is a completely different borrowing environment. And when we're looking at a deposit, so in the UK, we can go as low as 5%, whereas in Brazil, there's a higher requirement for the deposit as well. So we're typically looking at 20 to 30% deposit. What means that in terms of a loan to value, which is the percentage of the property that you own, in the UK, you owe, in the UK, you can go right up to 95%, whilst in Brazil will be in the 70% mark. So in terms of the loan, the time you can have a mortgage over, in the UK, you can go right up to 40 years, which means lower monthly payments and a lot more flexibility. Whereas instead of the FGTS, which most or a lot of us might have used in Brazil, the UK has its own government scheme for first-time buyers. So what the key point for all of this I wanted to compare is the UK borrowing is significantly cheaper in absolute terms, but qualifying for it could be a little bit harder than you might expect. So especially if you are foreign born or you have income in Brazil. So that is what we're going to go into now. So when I talk about mindset, this is one of my favorite parts to talk about because it gets to something that I don't think it gets discussed enough. So when I first start working with Brazilians, I noticed something that the advice I was given, it was correct. However, sometimes it just didn't land. And after talking to many different people, I realized that it was because the financial instincts people bringing from Brazil are completely different to the ones that UK system are built on. So none of them is wrong. It's just they are different. They are shaped by lived experiences. So let me give you a few examples. So when you're buying a home in the UK, a mortgage is just a normal part of life. So people, they take on a 30-year mortgage and that would allow them to keep their money invested elsewhere. And they don't really feel the urgency to pay it off early. Whilst in Brazil, owning your home outright means safety. So the idea of carrying that for decades, it might feel uncomfortable. And a lot of that, it comes from our parents, grandparents, where that was generally dangerous. Also, then we can look at property here when we buy as an investment. So a lot of investors in the UK look at property and ask, is this the best use of my capital? So they would compare how that would perform against their pensions, their ISAs, their stock market. So they would think about what yield and what the tax efficiency behind it. Whereas a lot of Brazilian investors or people that grew up in Brazil and have that mindset will look at property and think, is this is solid, this is real. So this cannot really disappear. So historically, given what inflation and currency devaluation have done in Brazil, that was a complete rational response. And finally, when it goes to retirement planning, and Tom will talk a lot more in that about it, this is where the gap is the biggest because in the UK, a pension is a retirement engine. It's automatic. It has tax relief, and employers and it's got tax relief, and employers top up on top of it. So most British professionals, they are building wealth through their pension without even thinking about it. So whereas in Brazil, trust in long-term institutions has historically been a lot lower. So people rely a lot more on properties and or fixed income or sometimes family, whereas pension might feel a bit more abstract. So one of my biggest insights when I talk about this is that in the UK, people will use this system, whereas in Brazil, people might need to protect themselves from the system sometimes. So that's one difference that shapes everything and how people think about debt, property, pension, and risk. So once you understand that, you can start making deliberate choices. Our about mindset serves you the best. As I mentioned, we're going to talk a little bit about the common pitfalls that might catch us off guard. So when we look at the number one pitfall that people might not think about is the credit history. Or if you lived in Brazil, or if you have been here not long enough, your credit history from Brazil means nothing here. So lenders, they might have not heard about those credit like Serasa, SPC. So for them, we are a blank file. And a blank file, from the lender's perspective, it reads like risk. So the fix is simple, but it takes a bit of time. So the first step is to having bank accounts, registering for the electoral roll if we can, and get a UK credit card, which you will pay in full every month, and that helps you to build on top of it. So the second one, and I think it could be potentially relevant to a lot of people here, is the complexities of a foreign income. A lot of lenders will not accept Brazilian income or real actually. And for the other ones that would accept it, they would apply what we call a haircut. So they won't use the full 100% of what we're actually earning. They will limit it to 75 to 8%. So that's why it's so important that if you have foreign income, to use a specialist broker, because a high street banker might not accept it. However, there will be lenders out there that can accept all of these most complex and mixed type of income. Now, stamp duty. Most of you might have heard about it. And I'll talk a little bit in terms of what is one of the big questions and the biggest cost of the whole buying process. So stamp duty is the tax that you pay when you purchase a property in the UK. So it's calculated as a percentage of the of the purchase price. And for higher value properties, or if you're buying as a second home, those percentages climb quickly. We are potentially talk tens of thousands, and it is all paid on completion. So it doesn't get added to the mortgage, it's not being able to pay on installments. And if we have other properties elsewhere in different countries, or not, that's not in the UK, it does count as well. So this needs a lot of planning, especially if you've got properties back in Brazil or in different countries as well. So now I'll go into the number 4, which is the deposit source. So the UK has strict anti-money laundering rules. And this is an area where transactions fall apart right at the finish line. So if your deposit is coming from Brazil, it might be from savings, from property sales, from inheritance, from gifts from family. You will need a complete paper trail. So bank statements, proof of sale, a letter from the person who is gifting the money. So your solicitors will ask for all of it, and they were unable to proceed without having the full documentation in hand. So I've had clients that left right until the end of the process and they were not able to complete because the solicitors could not confirm where the money was coming from. So as a massive, if you can take something away from today, is preparation. So start in at least 3 to 6 months before you plan to buy, and otherwise it could potentially stop you from buying when you're ready to do so. So another area that causes a lot of anxiety is when you found your property. So it's really important for you to have an agreement in principle in hand. So agreement in principle is like a letter from the bank saying that you are allowed, so they are prepared to lend you the money. So when you find a property that you love and you want to make an offer, the estate agents will ask you, do you have an AIP or an agreement in principle? So it's a document from the lender. They will confirm they are willing to lend you a certain amount of money in principle. So it's not a full mortgage offer yet. But without that one, a lot of estate agents, they won't take you seriously. And in a competitive market where things move really fast, you might end up losing the property that you love because you're not prepared enough. So the good news is you can get ready for it, and it takes days to get one. So before you start doing viewings, just get ready and make sure that you know exactly what you can borrow and how much they're going to cost you. And the last one is the differences between freehold and leasehold. So this one, it catches most of us, especially because that's not something that exists in Brazil. So when you buy a house in the UK, you typically own the building and the land that sits on it, which is called the freehold. You own it completely. However, when you buy a flat, you normally own, so you've got a lease, which means that you've got the right to have that property there for a certain amount of years. And after that, technically, it reverts to the freeholder. So that is the leasehold, is a contract that you have with the freeholder to allow you to have that property there. So it's really important to know if the property that you're buying is leasehold, freehold, and if it's a leasehold, the terms of that lease and how long it's for, because it can be quite costly to have a short leasehold. Now, we're going to talk quickly about the stamp duty. So I've mentioned as one of the biggest costs, and the way it's calculated is on a sliding scale. So you pay, it depends on where you sit and what type of buyer you are. You pay nothing on the first portion. And then as the property is more expensive, you will get more. So that cost will increase. When it gets expensive is if you already own property anywhere else in the world, and if you're not yet a UK resident, so there would be a surcharge on that as well. So just give a real example. So if you are professional buying a 600,000 property as a second home, so it means that you might have another property in Brazil that you lived in the past, and you haven't been here for, so you're not still a resident, so you haven't been here for the past 183 days for the last 12 months. That means that your stamp duty for that 600 property could get up to £60,000. There are some things you can claim back afterwards once you reach the residency stage, or if you sell your other property. But those are questions that are really important that you speak with a solicitor prior to your purchase, so you're not caught by surprise, because some people might not take that into account. And then if I've got the money for the deposit, it's all here, but they haven't calculated how much stamp duty they would be liable for at the end of their purchase. Right, so just before I hand it over to Tom, I want to leave you with something a bit more practical, which is some of the steps that I always talk about with my clients when they're going through their property purchasing and preparing them to get ready to buying their first, their second, or their 10th property. So first one is know your credit. So understand how agencies, the credit agency sees your file and what information they record about you. If you can, register on electoral roll and start building your credit just from from day one, so not from the future, from now. Number two, you would be an agreement in principle. So it might be your first property, it might be your investment property, it might be not the building that you're buying as an investment. Always know how much you can borrow and if the deal is doable. So know your numbers before you fall in love with the property that you're looking to get. Number three, calculate your stamp duty. So again, always know what is going to be the total cost from the process. Now, number four is regarding the mortgage broker, the specialist, that I believe it can make or break a good deal. So not all brokers can handle foreign income, non-UK credit history, or cross-border situations, or having a business here, having income from Brazil. So most of them will say, I'm sorry, I cannot lend it. So find someone that can help you with those. Number five, use a currency specialist for large transfers. So don't go straight to your banks, neither here nor in Brazil. So look at alternative currency exchanges, because if you're looking at transferring 300, 400,000, that margin difference can save you thousands in terms of what exchange you can get. So do a bit of research before going straight there. And number six, gather all of the documentation right from the beginning, especially if the money is coming from different areas. So don't wait until your offer is accepted. Start to get all of the paper trail for all of the money involved in the process. So now number 7 is regarding any overseas property and debt up front. So always disclose, whoever is working with you, whoever mortgage advisor you're working with, disclose everything, because it could impact your UK borrowing capacity, and the right broker will know how to navigate it. So it might kill the deal if you, so everything that's done with transparency, it gets easier for approval. And again, and finally, check the lease up front on your property, if there is a lease on that. So thank you so much for your time today. It's been a pleasure to be here with you. So Fernanda and Tom now will take over. And if you've got any questions, I'll answer them at the end of all the presentations. Many thanks. Bye-bye.
Perfect. That was a heck of a presentation to continue from, so I'll try my absolute best. So if you just bear with me, ladies and gents, just while I bring up my presentation. A little bit of lag there, so I should be with you. Please be patient. So good afternoon, everyone, and it's great to have you here. So I'm Tom, an independent financial advisor in the UK. So I work with professionals and business owners on structuring their finances, and over the years, a growing part of that work has actually been with Brazilians, largely through working alongside Taihnee. So in this part of the webinar, we're going to be going through and taking a look at how the UK financial system works, particularly around property, pension, and long-term financial planning, and how Brazilians living here can make these tools a little bit more efficient. Because the reality is that in the UK and Brazilian systems, they do actually work very differently. And once you kind of understand how the UK system is designed, you can actually start to take advantage. Now, something that has been coming up in almost every single conversation I've had with my Brazilian clients specifically is in Brazil, property is, I would say, probably at the heart of financial planning. So you've got the security, you've got the stability, and something tangible. And that kind of makes complete sense in the Brazilian context. But the UK system works slightly differently. So it's not one piece of a bigger picture. So it's not the entire strategy. The big difference is pensions. So, for example, in Brazil, they're often treated with skepticism. And in the UK, they're actually probably one of the most powerful tax tools available. So, for an example, an additional rate taxpayer can get up to a whopping 45% of tax relief on their contributions. So to give you an example, a £10,000 contribution might actually cost you closer to about £5,500. And that money, as you know, will grow free of income tax and capital gains tax for decades to come. And that over time can significantly compound. So not to forget, there's also inheritance tax. Now that's a whopping 40% on estates above certain thresholds. And those thresholds keep getting frozen, and they have been for many years. So many families now we're finding are actually getting caught in without actually realizing it. And something that Fernanda is going to touch on is the worldwide income reporting. So once you become a UK tax resident, income from Brazil, rents, investments, assets, they all need to be declared. So Fernanda will cover this practical side of moving money back between countries shortly, but the headline is this, that applying Brazilian financial assumptions in the UK sometimes can be quite expensive. So how does wealth actually tend to get structured here in the UK? Well, to keep things simple, there are three main building blocks, or three pillars, if you like. So the three pillars are property, pensions, and liquid investments. So, for example, your stocks and shares ISA or your bonds. So property will give you the stability and the long-term growth. Pensions will follow up by giving you tax efficiency and retirement income. And then the liquid investments will give you flexibility and, of course, access to the capital when you need it, whether it's before or in retirement. So property is usually where people start. And I think Tiny's already walked us through how that works. But ideally, the property will sit alongside the other two pillars and not instead of them. So the mistake that I see regularly is someone trying to make one pillar do the job of all three. And that's normally where the problems come in. So let me ask you something quickly. Right now, what percentage of your wealth is sitting in property? Is it 0%, 20, 50, or 80% or more? Because what we see is very often with international professionals, and this isn't a criticism, it's simply a pattern, is heavy concentration in one single asset. Now, that doesn't automatically mean it's wrong, but what it does mean is risk is really worth thinking about. So property can absolutely be a fantastic investment. Nobody is saying it isn't, but concentration does create risk, and it's worth being really honest about what that actually means. So property is, as you'll know, relatively illiquid. For example, you can't sell half a flat if you suddenly need capital. It involves leverage, which magnifies both your gains and also your losses. So it's exposed to regulatory changes. And in the UK rental market, we've seen so many of these in recent years. So for international investors, there's also that currency exposure, which is happening between the pound and the real, which can obviously have a real impact on your financial picture. And perhaps most importantly, property alone doesn't solve the question of retirement income. It helps, but it doesn't answer it on its own. So this leads to something I regularly say to my clients. If most of your wealth sits in one asset class, you don't have a strategy, you actually have more of an exposure. So that brings us back to pensions and why they matter so much, I would say, probably in the UK context more. So for business owners and high earners in particularly, pensions can be remarkably powerful. For example, company directors can often make contributions directly from their company into their pension, and those contributions may be treated as a business expense. So inside the pension, investments will grow free from income tax and the capital gains, and depending on the circumstances, pensions could also sit outside the taxable estate for inheritance tax. But that being said, it is worth flagging that the government very kindly has announced that from April 27, unused pension funds may start to form part of someone's estate inheritance tax when they pass away. So that's an area that is ever evolving, and it's really worth keeping a close eye on. And finally, one of the many key benefits of the UK pension is the tax-free lump sum. So when you start accessing your pension, you can usually take about 25% of the pension value as a tax-free lump, with the remaining funds then used to provide a taxable retirement income. And here's something that often surprises people when I mention it. So there are certain types of UK pensions that can actually hold commercial property directly. So imagine a business owner who's currently renting out their office or their workplace. Every month they pay their rent and that money goes to the landlord. But in some cases, the pension can actually purchase that building, and the business would then pay its rent to the pension instead. So the rent still gets paid each month, but now its building's value is inside the owner's pension rather than someone else's property. So over time, as you'll appreciate, that kind of rent becomes part of their retirement wealth for the future. Now, of course, it has to be structured properly, so it requires professional valuation, compliance with pension rules, and obviously the right advice, but that's not obviously going to be for everybody. Now, but when it does fit the situation, it can be a really elegant piece of planning. So you're essentially turning a business expense into part of your future retirement. So another thing I see quite often is professionals who only start thinking seriously about financial structure 10 or 15 years into their careers, at the point where significant wealth had already started to build up. And by then, restructure can become considerably more complicated and sometimes even more expensive. So if there's one thing I'd love you to take away from today is that high income alone doesn't automatically create financial security. Financial security tends to come from getting the right structure in place early and then giving it time to grow. The UK system genuinely offers some of the most powerful tools, whether it's property, whether it's pensions, tax-efficient investments, but they work best when they're used together and not in isolation. So I hope today has given you a clearer sense of how that can all fit together. And that's the end of my section. So thank you so much for listening to this afternoon. And I really do appreciate you being here. If you'd ever like to have a chat about financial planning, pensions, or just how to structure things in your career, the details are on the screen. Thank you again and enjoy the rest of your session.
Okay. Thank you, Taihnee. Thank you, Tom, and the Brazilian Chamber of Commerce, which is an absolute pleasure to be here. And another meeting, another of those fantastic webinars. Usually it's the tax committee organizing a webinar, but I'm very happy to be in this webinar today. I'm going to share my screen. Let's see if it... I suppose it's visible now. So I'm Fernanda Rossato. I've been in the UK as well, the same as Taihnee, for over 20 years. And I'm a Brazilian tax lawyer. My team is also in Brazil. And in the UK, I'm a chartered accountant. So we deal with Brazil-UK tax matters. And today we're going to be looking to tax considerations for Brazilians buying UK property. But a lot of this is also applicable for what Tom has said about having assets in the UK as a whole. Okay. So as Taihnee said and Tom said, Brazilian professionals in the UK, they often maintain financial connections in Brazil. Savings, property ownership, or family assets. It's part of our culture. A lot of people do have a business in Brazil that they are shareholders along with their siblings, or so it's not so much that the planning is done from an individual level, but a lot of people plan as a family planning, and this has to be considered. And because people have financial activities in two jurisdictions, tax consequences arise in both countries. So this is something people have to understand, that when they're going to do this planning, it has to look from Brazil and UK point of view. Brazil, a lot of changes in Brazil at the moment, and people have been doing business structures that make sense from a Brazilian perspective, but they need to look from UK as well. Okay. So key topics today will be, I will start with tax residency and the saída definitiva. It's a major topic of anxiety for a lot of people, or things that they would like to get done. So I would like to start with tax residency. And then how the UK taxes foreign income and gains. So an income from Brazil, how does the UK consider that? I will look into the historic non-domiciled regime and the new foreign income and gains regime. We have two regimes in the UK that we need to consider at the moment. Then this temporary repatriation facility, how to bring assets from Brazil into the UK. So often money, cash, how to repatriate that from Brazil to the UK. And opportunities and considerations. Okay. As I said, the first topic I was going to talk is the Brazil tax residency. My apologies, the legislation in Portuguese, but I thought it was key. There's so many questions about saída definitiva that it's important to look into what the legislation actually says. So it's not resident in Brazil, someone who has left Brazil from the date of departure, or someone who has left Brazil and hasn't returned in 12 months. So those are the 2 dates that the legislation does say, the day that the person left or when it has been 12 months. In practice, a lot of people might have been one date or another date, but they have continued to behave as tax residents. So if one of those dates are not the best date or the date that it makes sense to do the saída definitiva, we can certainly analyze and pick another date for saída definitiva, date of departure. But those are the 2 dates that we need to consider. And I've seen a lot of people saying, oh, but I have spent less than 183 days. And that's why I put the legislation here, and I'm going to share my screen and share my slides later. 183 days is applicable for people on a temporary visa. So I suppose most of the participants here today are Brazilian, so they are not in Brazil on a visa. So 100 days to 3 days is not really one of the key elements for a Brazilian person, okay? And I'll be sharing this later. 3 steps for doing a Brazilian tax exit. Comunicação da saída definitiva, when you tell the authorities that you're no longer tax resident there. And then the declaração de saída definitiva, when you actually tell Brazilian authorities that you're no longer tax resident there and you file your last Brazilian tax return. The reason I'm saying this is that if someone hasn't done the saída definitiva in Brazil, the minute they start earning in the UK, having assets in the UK, bank account, buying a property, they need to look into how to declare all this in Brazil or how to do their tax exit in Brazil. Otherwise, it can become complex. But the declaração de saída is the last element that people have to do to complete their tax exit. Once that is filed, they no longer treated as a Brazilian tax resident, so they no longer need to declare to Brazil all their investments in the UK. And they can still hold assets, receive income in Brazil, but taxes in Brazil will change. So if people have done a tax exit and now they are receiving a gift from a Brazilian family member to buy property in the UK, the applicable taxes will change. If they have assets in Brazil or income in Brazil, the tax rates will change, but they can still have a financial investments in Brazil and have those links in Brazil, but they need to look into the specific taxation and legislations for non-resident. So if someone hasn't done the saída definitiva, they need to remember to declare UK income and UK assets to Brazil, or they do the saída definitiva. That tends to be the case. Yeah, so effectively, if saída definitiva has not completed, or you're still behaving as a Brazilian tax resident, Receita might still treat you as a tax resident person. I say behaving as a Brazilian tax resident because I've seen a number of people do a saída definitiva, but they carry on declaring Brazilian tax returns or with regular bank accounts or doing things in general that looks like they are tax resident in Brazil. If that's the case, they need to remember to declare to Brazil worldwide income and assets, including the UK pension funds. This is a major, I've seen Brazilians that have built significant pension funds in the UK. They never declared in Brazil. Now they want to retire and go to Brazil, and they don't know how to incorporate those pension funds that they built in the UK in a Brazilian tax return. And yeah, there is possible Brazilian taxation on UK income, which is not ideal. Okay. The other thing I was going to say, for a lot of people here, I suppose they're all UK tax resident. So the same way that UK has a piece, Brazil has a piece of legislation that says who is tax resident in Brazil, UK has as well the statutory residence test. It's not just the number of days, but it's the ties that someone has with the UK. But I suppose most people arrive in the UK very quickly, they become tax resident in the UK. And once they are UK tax resident, they need to think how they're going to declare UK Brazilian assets or Brazilian income or overseas American income, all sorts of things that people have. So historically, and I suppose people have seen on the news a lot, there was the non-domiciled regime. And under that regime, there were 2 bases of taxation, but now we have a new regime, the foreign income and gains regime. The reason I'm talking about both is a lot of people that Taihnee or Tom will be assisting, they are bringing wealth that they accumulated in Brazil to the UK, but they accumulated over years of the non-domiciled regime and then years of the FIG regime. So we need to look into both when declaring Brazilian wealth or Brazilian assets earnings in the UK. So a default UK position is that people have to declare worldwide income and gains, regardless of the fact that they have done a saída definitiva or not, or if the money was earned in Brazil. The general rule is that they have to declare here. So rental income, dividends, If someone is in the UK and they have dividends from a Brazilian entity, it's particularly relevant to understand what's your participation in that company, if you what's the role that you do in the UK for a Brazilian company. So it can be quite complex, but that's the default. If people are paying taxes in Brazil, they may get a mitigation. They may get a relief. So depending on the taxes paid in Brazil, we can use that as a credit in the UK. And as most people would know, the Double Taxation Convention has been signed, but it's not yet in force. So that's something to bear in mind and keep checking. But it wouldn't change a lot anyway, even when that is in force. Depends on circumstances, really. So there is a bit here on the non-domiciled regime. And because of time, I will be sharing my slides, but I'm not going to go into the detail. But this idea that people only declare money from Brazil in the UK is based on the remittance basis. And the default is people should declare worldwide income and gains, or they declare remittances to the UK, but they had to be claimed. They had to make a claim to a tax return. So that's not the default basis. So that's something that I see that people might need to look into, how they have done that in the past and if it was done correctly. But I think what's very important now is the new regime and people looking to what they're going to do in the future if they're planning on investing in the UK or buy a property in the UK. And the foreign income and gains regime is a temporary period on which foreign income may not be taxed in the UK. So if someone has just arrived in the UK, I say just arrived, but it's 4 years of UK tax residence, certain income from Brazil is not going to be taxed in the UK. So if someone does qualify and is in the first 4 years of UK tax residence, this is very, very good because it's potentially money that should be declared to the UK and would be tax-free. But they still need to remember to declare within the deadline. So if they don't declare, there are penalties. And once they opt for this regime, they will lose personal income tax allowances and there'll be consequences. But if someone is in the first 4 years of being in the UK and they're thinking of how to invest in the UK and all that, we can consider the foreign income and gains regime. It could be very good. For people who have been in the UK for longer than 4 years, there is a temporary repatriation facility. So it's a period that they can declare income from abroad and bring into the UK. And it could facilitate the purchase of UK property, or maybe they're going to bring income from Brazil and put into a UK pension, something like that. But it's also a period, and it has started. It's like we are currently on the temporary repatriation facility years now. So the tax rates are very attractive. It's 12% to 15%. And it's only available for 2025, 26, 26, 27, 27, 28. So it's something that people need to plan now if the conditions are met. And I suppose this is one that brings anxiety to a lot of clients, but always say that people need to be aware, and before they start planning UK or Brazil or investments and how to do, it's just that there is sharing UK and Brazil, they are signatories of agreements on which they share financial information. And they have been sharing. And I've noticed more and more an increase of people who receive letters from HMRC or from Receita Federal, well, specifically HMRC, when they have been informed that this person has assets in Brazil, or not really assets, but like financial assets, investments in Brazil. And one that I thought was really relevant to this webinar is future development. So since December 2025, I don't know if Taihnee has seen, but Brazil and UK have signed, they have committed to share information on properties. So they also going to share information of properties that people own in Brazil when they bought and when they disposed of that property. This is particularly relevant because if once you buy a UK property, unless you have done a saída definitiva, tax exit, this UK property has to be declared in Brazil. If it's not declared then, it's something that UK will always, like in 20 years' time, UK will be able to send that information to Brazil. So this is quite relevant and something to get it right before buying UK property. For UK pensions, it's already some kind of information that can be shared with Brazil, although I haven't seen practice. But for properties, I thought that was a very big development. And also, if people have properties in Brazil and they buy UK property, there is the additional stamp duty. So that's quite unfortunate because sometimes the Brazilian property is worth even less than this additional stamp duty in the UK. So something to be considering and calculate, see if it's worthwhile selling the Brazilian property, if their capital gains should be paid. Taihnee has said, but I will stress clear documentation is essential. And when Taihnee is helping people get to their mortgage approved, I've seen over and over that solicitors, sometimes on the last day, we've seen cases on the completion day, they decide to ask further information on the source of funds. So I can help get the documentation in order, and we can provide letters that says this is a disposal of a property in Brazil, taxes were paid there, this is a receipt of the tax being paid in Brazil, money has come to the UK, tax will be paid in the UK in January 2027. We can prepare a letter or something like that, and I say, I'm a lawyer there, chartered accountant here, and it may help to explain the origin of the funds. So it may be something that helps people when it's complicated, when it's a complicated scenario. And then the common pitfalls that I've seen is when people forget to declare UK property to Receita Federal. They haven't done the tax exit, they have UK property, and they don't know how to go about that because the UK property in reais is worth a lot. So suddenly it's an asset that has been omitted from Brazilian tax return. And you need to have a consideration there on how to get this right. Yeah. I've seen as well with inheritances, either a gift or when people receive an inheritance, if they do a saída definitiva or if they don't, how they're going to bring that into the UK, because there are different taxes there, sometimes even 15% tax applicable on the receipt of an inheritance. And it may hit them unexpectedly if they were expecting the whole inheritance to be brought into the UK for the purchase of the property, and then suddenly they have 15% tax in Brazil. It's not something that they were expecting to pay there, and is not a tax that they can use to mitigate UK tax. So you can't get relief. You pay tax in Brazil, this particular one that I'm talking about, and you can't get a relief in the UK for the tax paid there. Large international transfers may trigger HMRC inquiries. So you may receive, someone has done a transfer, may receive a letter from HMRC. But again, if the paper trail is correctly done, if you're comfortable that it has been correctly declared, it's not something to be worried before doing the transfer. But if you think that it might not be right, then yes, need to be looked into. Ownership of Brazilian property may increase UK stamp duty in the UK. So yeah, something that Taihnee can certainly advise on. And if people continue to be resident in both countries, because it makes sense or because they realize they have to do it in a different way, they would have difficulty demonstrating accumulated wealth. So again, this is something that we have to look, how much do you have in assets here? How much do you have there? How are you going to declare? Should you do a tax exit? Should you return? What's your long-term plan? I like to start with people long-term plan and then see how to get things right. Okay, so that's it from me. And do get in touch, contact us via LinkedIn or Instagram, or there's quite a lot of information on our blog. And open for questions and a discussion. Thank you. Okay. Are you still seeing my screen? No.
I
No,
can
can't see.
see you.
Okay.
Yeah.
Just you, Fernanda.
Oh, I can see questions here.
Yes.
And some that are, yes, I recognize. Okay. Seeing that I've just spoken about the tax implications, let me see if there is any here that would be, I can see.
So here, I
is
think
there
there's one for
requirement?
you, Fernanda. So for a Brazilian who is a long-term UK tax resident, who is about to inherit and receive donations of shares in Brazilian holding companies as part of family succession plan, how should they think about the interaction between UK inheritance tax at 40% and Brazilian ETCMD, given there is no bilateral treaty? So is the key to minimize what enters your UK state, or are they structuring approaches that address both sides?
Okay, Pedro Gastal. Yeah, for Brazilian who is a long-term UK tax resident, who is about to inherit or receive donations of shares in a Brazilian home. So when someone's a long-term UK tax resident, the first thing I would be worried here, if you're receiving or if someone is receiving shares in a holding company in Brazil, is which role the person is carrying out from the UK. Because not just for inheritance tax purpose or UK income tax purpose, but the UK may see that part of the operations of this Brazilian company is being carried out from the UK. So there is like UK, even corporation tax implications here of receiving a large number of shares and carrying out operations from the UK, even though the company is in Brazil. So I don't know what's the percentage there, but that's something to look into. UK inheritance tax, so we would need to look into what's the long-term plan. If this person is going to carry on being in the UK, we need to look into the UK inheritance tax for sure. If this person, or if Pedro is, I don't know Pedro's age, but if you planning to stay in the UK for maybe another 5 years, and then you're quite young, unlikely, it's hard, but unlikely to die in the next 5 years or something, and then you're going to live abroad and not return to the UK for another 10 years. So potentially this is not going to be part of UK inheritance tax anyway. So there are all those implications, but yes, they can't get ITSMD as a deduction on UK taxes. So ITSMD may be something that people they pay in Brazil, and they can't use that to deduct against UK taxes. The other thing here that I was going to consider is, so if someone has done a tax exit, I don't know if Pedro has done a tax exit, but if someone has done a Brazilian tax exit and they receive an inheritance in Brazil, there are discussions as well if ITSMD is the only tax applicable there, or if they need to pay more taxes in Brazil. Receita was trying to tax people on 15% on receipt of inheritance as well. Yeah, so that's quite a tricky one, but something to be considered. Yeah.
Thank you. There's quite a lot of questions, and we will need to finish by 3. So I don't think we would be able to cover all of the questions that were sent.
Can I have one? Yeah, can I just have
One from Manuela that's quite easy to
there's
answer.
one for. So I want to say, Fernanda. So I'll give Tom to answer one that was directed at him as well, and then there's another one, and then all the other ones we maybe can go back to the people that asked, so we all get a chance to answer one of the questions asked. So for you, Tom, is there a rule of thumb if it's better to pay earlier your mortgage or invest, redirect to pension that money?
Yeah, so do you know what? I get asked that question a lot, and it depends how you look at it. So there's 2 ways to look at it. So if you look at it from an emotional perspective, then you will know what you really want to do. Do you want to be mortgage free earlier? Do the maths stack up with that? Well, it depends. So I would say, for a simple rule of thumb, and if you lose it, you're using literally mathematics, I would say if your mortgage interest rate is lower than the expected long-term investment return, but you've got to be careful here, because remember, there's potential pension tax relief as well that you need to take into consideration. So you'd be looking at your tax bracket. And you'd be looking versus investing the money instead of overpaying your mortgage. So in other words, if your mortgage interest rate is lower than expected, long-term investment, you would probably look to invest the money. So if your mortgage was, let's say, I don't know, 3.5%, 4%, that money, you're happy to be tied away for 5-10 years. Generally speaking, you're going to do better investing it. So pound for pound, invest. If your mortgage rate is higher than what you'd realistically expect to earn from investments, I would simply overpay the mortgage. But again, something really to remember here, and people do forget this, is if you need that money, it can be very difficult to get it out of your property versus taking it out of your stocks and shares ISA, for example. So I would bear that in mind as well. Hopefully that answers some of your question.
Just one question that was when I was presenting. So from Caroline, is it possible to buy without a mortgage advisor? The simple answer is yes, it is. You can go straight to your bank. So the banks will also have a mortgage advisor that's tied to that particular bank, and you can go through the process with them. The advantage of using a mortgage advisor that normally would be independent is normally, if you're independent, you have access to multiple different lenders, so we are able to compare the best deal. Also, if you've got any particularity, like I was discussing during the presentation, so might have foreign income, might not have indefinite leave to remain, or might not have a British citizenship yet. So a mortgage advisor would be able to look at different criteria that must potentially suit you better. So you can compare, you've got a broader support from that side. Fernanda, there was a couple of other questions here that you mentioned you wanted to answer one of the questions. What question did you say was the? I cannot hear you, Fernanda. I think you're on mute. I'm sorry.
Okay, it was this one from Ricardo. If I buy or build a house in Brazil, do I need to declare and pay tax in the UK, or taxes due if I sell the property? So if someone buy or build a house in Brazil, you only pay taxes in the UK when you sell that house in Brazil and you have capital gains there and capital gains potentially here as well. If you get rental income from Brazil, from the UK, you have to declare the rental income. If you have rental income in Brazil, you need to declare in the UK self-assessment tax return. So that's the key. And also stamp duty, if someone's later going to buy a UK house, then they need to consider additional stamp duty. But those are the key things when they have a house somewhere else. Yeah.
Thank you. Taihnee, just a quick answer to you. These lines will be available from the recordings, and I believe they will be available from the Brazilian Chamber of Commerce. I think Lena will be sharing that on the website at a later date. So they've got all these slides as well.
Manuela, the Temporary Repatriation Facility, they didn't need the paperwork prior to sending money from Brazil. Often I disclose that on the self-assessment tax return. But if they are worried, they can get the paperwork done, but it's not something that people need to do before the self-assessment tax return. Yeah.
There was another question here. I think there's a quick answer to you. Is a requirement to declare interest from private pension received in Brazil in the self-assessment? Does it get taxed in the UK?
Oh, that's a very tricky one. I can speak to Ricardo later because it's not recognized as a pension from UK point of view. Yeah, even Tom is like this, isn't it? It's not a clear one. And, yeah, I will speak to Ricardo.
I wish it was.
Yeah.
Amazing. So what are the tax implications in Brazil for financial gifts from a Brazilian citizen if the funds in question are actually located in a third jurisdiction, such as US?
Which question is
that? Was from Rosalba. It's just below Pedro's question.
Okay. Oh, what are the tax implications in Brazil for financial gifts from a Brazilian citizen if the funds in question are actually located in the US? Okay. So someone who is Brazilian citizen, and I'm assuming they haven't done a Brazilian tax exit because they are Brazilian citizen and Brazilian tax resident. Well, they need to declare in the assets, like as an asset, they need to declare this increase in asset. More complicated cases that the states are trying to tax people when they are tax resident in Brazil on receipt of inheritance or gifts of abroad. So that's something that has been a lot of development later, because before they tried to tax, but it was being challenged and the states were not being able to tax, like say São Paulo state. But now they can, basically they're going to have more powers to tax that. So if that person, potentially that person should do a tax exit if that's, if they are citizen but not tax resident in Brazil, could be a case of doing a tax exit.
Thank you. And just one for you, Tom, the last one that I can see here. On pension planning, someone now working in the UK and planning to retire in the UK, but then moves to Brazil. Are there any implications on pensions payments made in the UK that should be factored in the planning?
Yeah, do you know what? I can see that now, Weber. That's a fantastic question. That's really, really good. So it's multifaceted answer, I'm afraid. Let me try and answer it best I can for you. So first of all, there are generally two ways that you can take your pension. So, for example, let's say you were retiring in the UK and moving to, I don't know, let's go with Portugal. Portugal have a system set up between the UK and Portugal where you are allowed to transfer your pension to a suitable, and when I say suitable, it has to be approved by HMRC, a suitable pension scheme in Portugal. That can have its advantages. However, let's say you go to Brazil. Brazil have no such arrangement at the moment with HMRC. So in other words, in short, HMRC do not approve the pensions that are in place in Brazil. So you cannot transfer your pension over. However, what you can do, and this is where Fernanda her expertise would genuinely come in here, is you would need to find out a tax efficient way of drawing that income from the UK pension over there. So that's kind of really demonstrating where you've got the multi-disciplines, where you've got Fernanda, you've got myself. So not a really in-depth answer, but best I can do on the fly, I'm afraid, Weber.
Thank you. So if I buy a house in the UK, do I need to declare it in Brazil if I am not tax resident there?
Okay, so Denise, that's a question from Denise. So you buy a house in the UK, and I'm assuming you have done a tax exit in Brazil, because sometimes people are not resident in Brazil anymore, but they haven't done the comunicação, the saída definitiva, and the declaração. So the first step is check that you've done both. If you haven't done both, then go and do your tax exit. Once you've done your tax exit and you have paper that has been processed, no, you do not need to declare UK property in Brazil. And declaring it would in effect making you Brazilian tax resident again. So it's not something to be declared there.
Thank you. And if I realize that I have outstanding matters from previous years on my self-assessment tax return, what do I need to do? That's from Andresa.
Yeah, so when people think, oh, maybe I was a non-dom, but I didn't claim that I was a non-dom and I didn't declare Brazilian income. If there is like any Brazilian income or overseas income that people haven't declared in the UK, there are two. One is voluntary disclosure. So you inform the authorities that you realize that there are issues, maybe spanning like 5 years, a few years, and you do a voluntary disclosure. Or potentially HMRC may send a letter and you have to do the same disclosure, but no longer voluntary. So the penalties for voluntary disclosure are lower, but that's done within the worldwide, as a worldwide disclosure that we do. If it's just one tax return, we can go and amend that one tax return. But if there is more, a worldwide disclosure is the best way to go. The first thing is always to calculate implications, and then look into how to put that right.
Thank you. I think that it comes to the end of all the questions I received, and we were actually able to respond to them all. That is amazing. I would like to thank everyone for the opportunity, for your time and being here and sharing a little bit of what we do. If anyone from our side has any questions, feel free to reach out to us, to one of us in all of the contact details shared before. Yeah. Any other final considerations, Fernanda, Tom?
No, I was just going to say it's a very complicated situation when it comes to anything pension, tax, mortgages. For any general inquiries, I'd be super happy. So if anybody, I'll pop it in the chat for you, my email address. Just drop me any general inquiries. Specific would need to be financial planning, but anything generally, anything that I can do to help you, drop me an email. I'd love to speak to you.
Perfect.
Yeah,
Thank
for me
you.
as well, I saw an extra question here about people moving from the UK to Spain. I do have a few contacts in Spain, but one key thing that I always say is to look into who is the best person to advise you. Maybe speaking to a Brazilian accountant that might be excellent dealing with business taxation or business accountancy matters in Brazil is not the best person to speak about saída definitiva or overseas assets. And I like to work with professionals that have experienced and they are, the best in their field. So I'm more than happy to work with your accountant in Brazil if that's the way to go, or your team of lawyers in Brazil or a team of lawyers here. And quite often we can do the tax returns in both countries, or we can be a bridge explaining how to go from one plan to another plan. So it really is a transition period. But yeah, Andresa, my team, we enjoy that a lot. And having webinars like this is excellent as well, because I saw from Tiny's perspective and Tom's perspective, very, very good. Thank you.
Thank you. Thank you all. Thank you so much. Have a great afternoon and see you again.